Hello and welcome to our third chapter on momentum trading. So today we're going to look at our first official trading strategy for trading futures contracts. And this is a simple idea. It's essentially a trend following strategy. And you can think of an analogy with predicting the weather. So the best predictor of tomorrow's weather is probably today's weather. So if it's raining today, it's more likely to rain tomorrow. And if it's sunny today, it's more likely to be sunny tomorrow. And the main idea of time series momentum is that price moves tend to continue due to trends in market prices, and particularly large price moves tend to precipitate further price moves. And there are many trading strategies, but time series momentum is a very popular one. Most large systematic funds will have some exposure to momentum, and the basic strategy is simple, but it also provides a good starting point for learning as well. So today we're going to focus on time series momentum trading, and I'm going to walk through two ways of building a signal. So the first one is the trend line filter. So let's explain how to build this simple time series momentum signal. So here I'm going to focus on daily returns. So everything I'm going to say now will be about daily returns, but you could use other types of returns like 5-minute returns, whatever your frequency of trading is. So to build a signal, we simply look back over the last week of trading. So say 5 days, the last 5 days, and we see has the price gone up or down. So it's a very simple idea. If the price has gone up, we take this signal to hold a long position. So we buy and hold a long position. If the price has gone down, we hold the short position. So we short the futures contract. And if the price has remained the same, we do not hold the asset. So we just go neutral. We don't hold anything. So mathematically, if xt is the price of the asset t, then our signal is S5, where Sn in general is 1 if the price has gone up over the last 10 days, 0 if the price has stayed the same, and -1 if the price has dropped over the last 10 days. So depending on the value of n, the above formula will give a different signal. So SNT is obviously dependent upon n, and smaller values of n will give a signal that changes more frequently in general. So if you're averaging over or summing over a smaller window, there's more potential for that value to fluctuate. And this is a good thing because if our signal is more reactive to market moves, then it can give more detailed information and boost the Sharpe ratio. However, a signal which changes more frequently will also incur more trading costs, as you'll need to buy and sell more times to finance this trading strategy. So this will add to the turnover, so it'll add to trading costs. So smaller values of n are good because they boost the Sharpe ratio potentially, but they're also have their negatives in that they increase the turnover. And life is always this balance between turnover and Sharpe ratio. So one nice thing about momentum is that the 1 month signal may have some diversification away from the 1 week signal. So if I look at S21, it may be slightly different from S5, but they both may have some signal in them. And moreover, they don't just both have some signal, they may be uncorrelated. And as we'll see later, combining uncorrelated strategies can boost the Sharpe ratio significantly. So this is the diversification effect. So we don't just want to take one time series momentum signal, we want to average a collection of time series momentum signals. So here's an example of a momentum signal a systematic hedge fund manager may use to gain exposure to 1 week, 2 week, 1 month, and 2 month momentum. So I just add up the momentum signals and take their average. So let's look at this in KDB. Here I have taken the gold futures contract again, and I am looking at the 1 week, 2 week, 1 month, and 2 month price momentum. So here's all the different signals. You can see in red the 2 month momentum. It doesn't change very often, as we spoke about. It's averaging over a longer window, so it's going to jump about less. And then in blue, we have this very frequently moving 1 week momentum. So it's going to have a much higher turnover, but hopefully capture a bit more Sharpe ratio. And then in between, we have the purple line, which is the average of all the momentums. So let me just show you this on one graph, just to make the point again. So here, the orange line is the 5 week momentum, or sorry, the 5 day 1 week momentum, and the blue line is the 2 month momentum. And you can see that that blue line, it changes from positive to negative very infrequently. So there's maybe once it happens here, once it happens here, once it happens here. There's a bit of a move back and forward here, and then once it happens here. So all in all, the 2 month momentum doesn't move about a lot. So it's going to have a low turnover, which is great. On the other hand, the orange line, the 1 week momentum, it's going to bounce about much more frequently because it's just depending on what happens over a week rather than what happens over 2 months. So the turnover for the 1 week momentum is going to be much greater, and we're going to incur a lot more trading costs, trading that much faster signal. So all in all, we'd hope that the orange line had a higher Sharpe ratio, but we know that it has a higher turnover, so it's always a balance of these two things. So what happens when we take the average of the 1 week, the 2 week, the 1 month, and the 2 month momentum? So then we're going to get this strategy we just discussed, which is diversified. And you can see that that strategy is much slower moving than the 1 week momentum, but it also captures some of that more quickly moving behavior. So it's kind of like the best of both worlds, and we've averaged a number of different strategies, so we should boost our Sharpe ratio using the diversification effect, which we'll talk about in later chapters. And we've reduced the turnover, and we've hopefully boosted the Sharpe ratio. So this is a good tip for building trading strategies, is to take a number of successful strategies which are somewhat orthogonal to one another and then average those. Okay, I think I've said enough about that. The next thing I want to talk about is a different way to build a momentum trading strategy, which is to use an exponentially weighted moving average. So a slightly more advanced way to capture time series momentum is using exponentially weighted moving averages. An EWMA, or an exponentially weighted moving average, is just a moving average that weighs more heavily recent results in the average. So as we move back in time, the importance of a value in the average decays exponentially. So for a time series xt, we say that the value of the EWMA at time t is equal to alpha times the value at time t plus 1 minus alpha times the EWMA at times t minus 1. So this is defined recursively, where the very first value is just equal to the first value in the time series. So if we're looking at not just the move over the last week, but we're looking at the EWMA with a parameter of alpha, say 1/5 or 1/n, then a momentum signal can be constructed from taking a fast move in EWMA minus a slower move in EWMA. So this is like a fast moving average and a slow moving average. Sometimes these are called sort of crossover indicators, where the fast moving average crosses over the slow moving average and you get some signal that to buy or sell. So here I've got the EWMA for 1/n and the EWMA for 1/3n, and I've subtracted those. So this will give me some signal. It won't be very well normalized. So what I can do is I can divide by the standard deviation. Here I've taken a standard deviation over 21 days, and I've computed that again using an EWMA just to make it more timely. So here's the KDP code in one line for the gold futures, and you can see there's kind of this pattern where it starts high, it drops, then it comes back again, and then there's kind of two bumps at the end. And in some ways we see that previously in our momentum signal with the trendline filter. There was some kind of relatively high performance, then it dropped, then it went up, and then there was kind of two bumps at the end. So there's some correlation or some similarity between these two strategies, but because the EWMA signals are biased to be towards more recent events, they're often preferred over these trendline filters. So they're hopefully you will achieve a better result with higher Sharpe ratio and lower turnover using the EWMAs. So yeah, in general, I would go for an EWMA filter over a trendline filter for building momentum, time series momentum. Okay, so that's a very quick introduction to time series momentum and our first look at building a trading strategy to trade futures contracts. Thank you.